Hello everybody, welcome to another update on a stock screener. Today I'm going to continue the Frontline earnings expectation uh, video that I made because there is something that's not correct. So just watch my last video and here we are going to correct something. So I assumed that costs will be the same, but that's not correct. So let's talk about this. So for the third quarter, we had revenue of 382, right? That's this. And then I looked at net income 82. And then I assumed that this cost would be the same. But that's not correct because when you look deeper, then you can see here that as the rates rise, then you see that the voyage expenses also rise, right? So we need to take this into account, and it's better to use the TCE instead of the revenue. So we are going to try to update the calculation by using TCE. Then you don't have this variable expense. Because when you look at the balance sheet, you have revenues. So this is for the 3 quarters. So you have revenues, and then you have this voyage expense and commission. If you deduct this, then you get the TCE. So it's a lot of costs. So from revenue going to TCE, you deduct this here, and then you get the TCE, right? Because this is voyage expense and commission. And as you can see here, going from revenue to TCE, you have the voyage expense and commissions, right? And then here, let's take a look at this. So the TCE is 204. That's basically this number here. So from revenue going to TCE. And spot days, if you do this times the spot TCE, then you get this here. And if you then add all of this, then you get the total TCE, right? So these numbers here are used here. That's the spot TCE that I used. And we are going to keep on using this, but instead of triangulating revenue, we need to add something else here. So let's do TCE earnings, earnings in. Okay, so what was the TCE earnings in the third quarter? Easy, that's this number, 205. Now, what was the cost? The cost is lower than because we deducted the voyage expenses. about 173. Yeah, it's about 173. So this is a total cost, but we need the cost, total cost minus voyage expense. So basically that is this minus the 173. So this is basically the fixed cost. Fixed costs. So let's say these are wrong numbers. So let's make this yellow. This is correct. This we will need to change, but let's make this yellow and add another row. Income based on TCE. So this is still our correct earnings. And here we need to make a new calculation. So how are we going to calculate this time? So income is TCE minus the costs. Okay, so TCE minus the fixed cost. That's what I think should be the earnings. So what is the TCE? TCE is, you can just use this formula. And then let's update it. So instead of using this revenue, we use this here. Okay. So now we use 32%. Still this spot days, that's correct. And then the VLCC TCE rates, which will go up, okay? But we use the TCE earnings. Okay, that looks good. Now what is the total cost minus expense? Yeah, that's the same because that should be a fixed cost, I think. So this should just be the same. And then we have the earnings. So the earnings are lower now. So PE ratio new. So these are wrong numbers. And then this is this divided by this. Divided by 4. So 3.75 now. So it's a bit higher. So instead of average of 3.3 PE, it's now 5 PE. which is not bad, but it's not as good as this one. So, but when you look at the future, we still get around a PE of 1. So the bull case is still here. As the VLCC rates rise, we should see a PE ratio of 1 in the future. Okay. So that also means if interest payments go to 0 when the debt is gone, then we still add 150 million yearly earnings. So that's 40 million added to this, for example. That would give us around 300 million. So the PE would go to 3. Here, when you add the 40 million, that would give us 200. So the PE would go to 5. So it's still high financial leverage. So in Q4 and Q1, they would be able to pay off 500 million in debt. 500 million in debt would be around 30 to 40% still of debt paid off, 30%, 35%. So not bad. Still a bull case, but less. Okay, so the PE ratio has gone up a bit when I use this new calculation based on TCEs and fixed costs. And this is minus 173 because I reduced the voyage expenses. Yeah, probably I should deduct this as well. 177 then. What happens when I do this? Yeah, you just use this. Okay. So this should be a better calculation. And the 205 is coming from this. Okay. So that was the update. And I'll see you in the next video. Bye.